A janitor dies with an $8 million fortune, leaving the vast majority of it to charity. A Harvard-educated Wall Street executive files for bankruptcy. Same country, same economy, same stock market. Completely opposite outcomes. The janitor never earned a high salary. He never had a finance degree. He just saved consistently, invested quietly, and waited. The executive had every advantage and lost it all. This is not a story about intelligence. It is a story about behavior. Morgan Housel's The Psychology of Money is one of the most widely read personal finance books of the last decade, and for good reason. It does not teach you how to pick stocks or build a portfolio. Instead, it asks a more important question. Why do smart people make terrible financial decisions, and why do ordinary people sometimes build extraordinary wealth? Most financial advice treats money like a math problem. Get the formula right, and the results follow. But that is not how it works in real life. The gap between knowing what to do and actually doing it is enormous, and it is filled entirely with psychology, fear, ego, impatience, and social comparison. Destroy more wealth than bad investments ever will. Understanding that gap is the first step to closing it. Here's the central idea of the entire book. Financial success is a soft skill. It is not about having the highest IQ, the best information, or the most sophisticated strategy. It is about behavior, patience, and emotional discipline. A person with average intelligence and excellent behavioral habits will consistently outperform a genius with poor emotional control. That is a counterintuitive claim, but the evidence for it is everywhere once you start looking. Behavior beats intelligence. Let's start with something most financial advice ignores. The reason two equally intelligent people can look at the same market data and reach completely opposite conclusions. It is not because one has better information. It is because they grew up in different worlds. Worldview and experience. Someone who experienced hyperinflation in childhood will distrust paper assets for the rest of their life. Not because they are irrational, but because their lived experience taught them a very real lesson. Someone who entered the stock market during a bull run in the 1990s has a completely different gut reaction to risk than someone who started investing right before a crash. Your personal financial history shapes roughly 80% of how you see the world, and that history is unique to you. No amount of data can fully override it. Luck and risk. But even when we make our own decisions, the outcomes are not entirely in our control. Luck and risk are invisible, but decisive forces. We love to study extreme successes like billionaires, but those stories are dangerous role models because they reflect the extreme ends of luck, not just replicable behavior. Nothing is ever as good or as bad as it seems. Reasonable over rational. This is why the reasonable over rational principle matters so much. The mathematically perfect investment strategy is useless if you cannot emotionally survive holding it through a 40% market drop. Harry Markowitz, the man who invented modern portfolio theory, used a simple 50-50 split for his own retirement savings, not to maximize returns but to minimize regret. Optimism paradox. And here is the paradox that closes this idea. Pessimism always sounds smarter. Warnings of disaster feel more credible than predictions of growth. But in the long run, optimism wins every single time. Once you understand how psychology drives financial behavior, the next question becomes, what are we actually trying to build? The answer might surprise you. The nature of wealth. Most people think wealth looks like a luxury car or a large house. It does not. In fact, those things are often the opposite of wealth. Wealth versus rich. Here is the distinction that changes everything. Being rich is about current income and visible spending. Being wealthy is about what you choose not to spend, the money that sits quietly as future options, flexibility, and freedom. You cannot see wealth. That is the whole point. When you see someone driving an expensive car, you admire the car, not the person, and the person driving it earns far less respect than they imagined. Wealth, by contrast, is invisible. It is the car not purchased, the upgrade declined, the investment account nobody sees. Savings formula. The most powerful formula in this section is simple. Savings equals income minus ego. Past a certain level of income, your savings rate is not about what you need. It is about how much you need to signal your status to others. Reducing that impulse is a legitimate and deeply underrated financial strategy. Highest dividend. But the highest return money can actually buy is not a material thing at all. It is time. Control over your own hours, your own mornings, your own decisions. Research consistently shows that autonomy over your time is a stronger predictor of happiness than income level. Define enough. And none of this is possible without first knowing you're enough. Social comparison has no finish line. It is designed to be unwinnable. Define enough and protect it before the goalpost moves again. Knowing what wealth really is gives you the destination. The next question is, what is the most reliable engine for getting there? Survival unlocks compounding. Here is a number that should stop you. Warren Buffett's net worth at age 30 was roughly $1 million. By age 60, it had grown to around $300 million. Today, it exceeds $80 billion. The overwhelming majority of that wealth was built after he turned 65. Edge of longevity. The lesson is not that Buffett is a genius. The lesson is that he never stopped. He invested consistently from age 10 to age 89 without a single catastrophic interruption. Longevity is the real edge. Time is the real weapon. Dueling mindsets. But here is the part most people miss. The mindset that builds wealth is the exact opposite of the mindset that keeps it. Building requires optimism, boldness, and risk-taking. Keeping requires paranoia, humility, and frugality. Rick Guerin, equally skilled as Buffett and Charlie Munger, used leverage, got caught in a downturn, received margin calls, and was forced to sell at the bottom. He never recovered to their level. The difference was not talent, it was survival. Power of tails, and here is the final piece. Most investments fail. Most businesses fail. Most individual decisions are wrong. That is completely normal. A tiny minority of outlier events, tail events, drive the vast majority of outcomes. 40% of Russell 3000's companies permanently lost most of their value, yet the index returned 73 times its original value, driven by just 7% of its components. You do not need to be right most of the time. You just need to stay in the game long enough to catch the moments when you are spectacularly right. Compounding is the engine, but the world is unpredictable. Markets are volatile, and plans fall apart. What do you do when reality does not cooperate? Price in uncertainty. Nobody predicted the 2008 financial crisis. Nobody predicted a global pandemic shutting down the world economy. Nobody predicted any of the most consequential financial events in modern history. Because the most disruptive events are, by definition, the ones with no precedent. History is not a reliable map for the future. It is a record of surprises. So what do you do with that? You price it in. Expect the unexpected. The most important part of any financial plan is planning for the reality that your plan will not go according to plan. Every projection, every forecast, every carefully built spreadsheet assumes a degree of predictability that the real world simply does not offer. Build that assumption into the plan itself. Volatility equals fee. The single most important reframe here is this. Market volatility is not a fine for making mistakes. It is the admission fee for long-term returns. Investors who try to avoid it through market timing and panic selling usually end up paying more than those who simply hold. Most of the market's best days happen within weeks of its worst. Exiting during fear means missing the recovery. Margin of safety. Margin of safety is the structural answer, not a strategy for predicting risk more accurately, but a buffer that makes accurate prediction unnecessary. A lean budget, no leverage, flexible timelines. You do not need to know what is coming. You just need to still be standing when it arrives. Barbell mindset. The mindset that holds all of this together is the barbell. Long-term optimism about where you are going combined with short-term paranoia about what could knock you off the path. Both at the same time, not one or the other, both. You can price in external uncertainty, but there is one more risk most financial advice ignores entirely, the risk of not knowing which game you are actually playing. Know your own game. Here's a mistake almost every investor makes without realizing it, taking behavioral cues from people playing a completely different game. Identify your game. A day trader who sells because they expect a short-term correction is making a rational decision for their time frame. A long-term investor reading that signal and copying the move is making a catastrophic mistake for their time frame. The prices are the same, the logic sounds the same, but the game is completely different. Many market bubbles are partly driven by this exact dynamic. Long-term investors watching short-term traders and mistaking their signals as relevant. Before you act on any financial signal, ask one question. Is the person sending this signal playing the same game I am? If not, their behavior tells you nothing useful. End of history illusion. But there is one more layer, the most personal one. You will change. Your values, your priorities, your life circumstances will shift in ways you cannot fully predict. Psychologists call this the end of history illusion. We acknowledge that we have changed significantly in the past, but assume our current self is the final version. Avoid extremes, extreme financial commitments, extreme austerity, extreme leverage, extreme sacrifice are bets that your future self will want exactly what your present self wants. That bet almost always loses. Aim for moderation, not because it is safe, but because it is flexible enough to survive where you are still becoming. Here are 5 things to carry forward from this book. 1. Your financial worldview is shaped by your personal history. Know your biases before they make your decisions for you. 2. Real wealth is invisible, measured by what you keep and preserve, not what you spend and display. 3. Survival is the most critical financial skill. Stay in the game long enough for compounding to reach its full power. 4. Price in uncertainty. Treat volatility as a fee you willingly pay, and always maintain a margin of safety. 5. Know your own game. Define your time horizon, your enough, and your goals, and refuse to be pulled off them by noise from different players. The psychology of money is not a new subject, but it is a deeply underappreciated one. The gap between what we know and what we actually do is enormous, and it is filled entirely with behavior. Getting smarter will not close that gap. Getting more self-aware will. The best financial decision you can make today is to understand yourself a little more clearly than you did yesterday. If this gave you a new way to think about money, subscribe for more.